What's up everybody, I am Jaspreet Singh, and the famous investor Cathie Wood went on to CNBC and gave a very interesting recession warning. Take a look.
I think the risk of recession has gone up dramatically.
And because of the growing risks of a recession, Cathie Wood says, interestingly, that the Federal Reserve Bank should not raise interest rates anymore. She says it's a bad idea because it would put the United States into an even deeper recession. Now, this is a little bit of a different proposal than the things that I've been talking about on our channel, because we've been talking about the risks of inflation, because inflation has been breaking records again and again and again, and in order to combat inflation, you have to raise interest rates. Now, the risk of raising interest rates is a recession. These inflation risks are why I've been talking about the Fed policy so much and why it's so important to raise interest rates to fight inflation. But Cathie Wood comes at it from a very different perspective because she's not worried about the inflation problem. She is more worried about the economy. And if you really want to understand where she's coming from, you have to understand what her goals are and what her visions of the future are. If you're not familiar with who Cathie Wood is, she is a famous investor. She is the founder of the ARK Innovation Funds, and ARK invests in some of the biggest tech and momentum names out there. She and her investment fund are major investors in growth companies like Tesla, Roku, Shopify, Zoom, and Square. She loves investing in innovation and disruption and entrepreneurship. That's why I like Cathie Wood, because I'm also an entrepreneur and I love the idea of innovation and entrepreneurship and disrupting things, which is exactly what Cathie Wood invests in. But it becomes interesting when you look at some of these investments, especially when you look at the broader economy. See, the problem with a lot of these startup and tech companies is they look at company growth like raise money, spend money, grow, scale, and then start thinking about generating a profit. This concept can be really hard to understand if you're not really involved in that startup space on the East Coast or the West Coast, because when most people think about starting a business, you think that I spend $100, then I better make $120 back. Because if you're not making the money that you're spending back, then you're not really a business, because you're losing money every single day. But on the coast, especially the East Coast and the West Coast, if you're starting a company, you don't want to be profitable. Because if you are a company and you have a profit, that means you have cash in the bank account that isn't doing anything. See, for these startup companies, cash is a liability. They don't want to hold on to cash because that's dollars that could have been used to go and find more customers. It's dollars that could have been used to create a better app. It's dollars that could have been used to build more products for their company. So these startup companies don't want a profit. Profits are bad news because they want to invest every dollar possible and more through the help of debt and investment dollars. That way they can grow as big as possible, as fast as possible. Let me show you a list of companies that were not profitable in 2021. This is from GoBankingRates.com. Airbnb, Blue Apron, Casper, Dropbox, Lyft, Peloton, Pinterest, Snap, Uber, WeWork, and Zillow. Now, you've probably heard of every single one of these companies, and these are all multi-billion-dollar massive companies that have had a major impact on a lot of people's lives. But in 2021, they were not profitable. Now, you gotta understand, what does profit mean? Profit means that your revenue minus expenses has a dollar number at the bottom. But what these companies have is revenue minus expenses equal a negative number. That means they're spending more money that they're earning, and the reason why they're spending more money that they're earning is because they're so focused on scale. They're focused on growing as big as possible, as fast as possible, using whatever money they can, using debt, using investment money. That way they can grow bigger and then start worrying about a profit when they need to later down the line. What Uber, the ride-sharing service, would do is when they would want to go out and start the service in a brand new country or a new city, they would incentivize drivers and customers by giving you more money. So if you wanted to go out on a $20 drive where a driver would make $20, they might only charge you $10 to go on that drive. Now you go out and you use Uber and you say, wow, what a great service, and it only cost me $10. And the driver says, hey, I made $20 for this drive. But if Uber is paying the driver $20 and you're only paying $10, how is Uber gonna be profitable? I mean, they're generating $10 but have $20 worth of expenses. Well, Uber would subsidize this cost through the help of cheap debt and through investment money. That way now you're gonna wanna use Uber because it's cheaper and you can build that loyalty instead of going through a taxi, because taxis didn't have that opportunity. A driver through a taxi would want $20, but Uber will let you do that same drive with $10. So why would you want to go through a taxi and pay $20 when you could just use Uber and pay $10, save money, and now Uber is getting more customers, they're growing, but they're losing money. The whole idea is once they can take that market share, then they can start raising their prices and maybe start paying the drivers less. That way Uber can start generating a profit sometime in the future. It's high risk, but it's also high potential reward. And these are the types of companies that Cathie Wood likes to invest in through the ARK fund. But what you have to understand is that these types of companies can thrive when you have a low interest rate environment, because now these companies can borrow money at 3, 4, 5% a year. And these types of startups, if you're doing it correctly, can grow by 20, 30, 40, even 50% a year. So if a company can borrow $100 million at 5% a year, and they can grow by 20% that same year, well, that's a pretty big profit, because now they can borrow money so cheap. They don't need to be profitable because the value of their company is growing and they can get money very easily. They can go to banks and borrow money because banks are willing to borrow money very cheap, or they can go to a venture capital firm and get money very easily because the venture capitalist is also borrowing hundreds of millions of dollars very cheaply. And this venture capital firm needs to put this money somewhere. So they're putting this money into startups because the startup just needs to grow more than 5% a year for the venture capital firm to be profitable. Now at this point you might be thinking, well, Jaspreet, what do you know? You're just a random guy on YouTube. Well, yeah, you're right. And the proof is not in the pudding, but it's in the numbers. Just take a look. In 2020, the ARK Innovation Funds by Cathie Wood saw massive returns that blew the market away. But then in 2021 and 2022, as inflation worries started to kick in, as interest rates started to go up, that's when the innovation funds by Cathie Wood started to get hit hard. Things move in cycles. We've talked about stock market booms and busts, but even within the stock market, you have some companies that see their own different cycles. Like when you're in a rising interest rate environment, people start to lose interest in unprofitable companies. That's what we're seeing happen right now as people move their money away from unprofitable companies into more profitable companies as a safer way to invest, because when you see rising interest rates, people are worried about an economic slowdown, which is not good for any company, but it's even more not good for companies that don't have any profits, because if the economy is slowing, you have no cash in the bank, and venture capital firms and banks don't have money to give you, well, then you're going to be the first one to shut down. So when it comes to investing your money in the stock market, you almost have two different types of categories. You have the Cathie Wood type, which is where you're investing in the innovation, you're investing in the growth, you're investing in the momentum, and then you have more of the value side. This is what people like Michael Burry and Warren Buffett invest in. These are people that look for big profits and look for companies that are growing, that are able to sustain themselves without external dollars. And now, because of the state of our economy and because of the state of inflation, we're going to see a change in the stock market. Even BlackRock came out and said that we're going to see a new world order in the stock market, because now these rising interest rates are going to be a very different environment for the stock market. And it's something that we haven't really ever seen in a long time, because ever since the 2000 dot-com crash, we've been seeing interest rates steadily go down over the decades. Now, before I get into what I'm doing with my money, I'll get into that in just a second. The reason why Cathie Wood says that the Fed should not be raising interest rates is because she says that the Fed should be more worried about an economic recession. She has a very different opinion on inflation, because what she says is, if we start to raise interest rates right now, we're going to cause an economic recession, and we're not going to be able to get out of this recession, and it's going to cause a major decline in the economy. Her opinion is we should continue to fight a recession, which means keep interest rates low, keep stimulating the economy, and the worry is, well, we'll have a whole lot of inflation. But what she says is, if we can keep interest rates low, keep borrowing money cheap, we can create more innovation. We'll allow more startups to grow. We'll allow more companies to thrive. And if we have more growing companies, then we will be able to create deflation by creating better products, by creating better technologies, which will allow the price of things to go down because of technology. That's what Cathie Wood believes. She's a big tech person. So she's hoping that we can fight inflation not through our monetary policies, but through technology. But the only way that we can fight inflation through technology is if we have a good monetary policy that will support these type of startups to grow and thrive. Now, if you are interested in learning more about how to invest your money in the stock market the right way, we have a free 1-hour lesson on how to invest your money in the stock market that you can watch for free in my Market Insiders app. It's an investing education app where every every week you get access to stock market, real estate, and cryptocurrency coaching. You can watch the stock market lesson for free. If you want to do that, I'll put the link to how you can do it down in the description below. So now the question is, what do you do? Because we have a potential inflation problem and we have this potential recession, and this recession is being caused by inflation, which is why this is such a unique situation. Now, I'm still investing my money in the stock market, but you have this Cathie Wood style, and then you have the more value investing style. And to be honest, I do both, because I invest in the ARK Innovation Funds and I also invest in value ETFs. The reason why is because guess what? Cathie Wood and Michael Burry are both extremely successful. They're both rich and they will make money in different times of the market. I am an investor. I don't invest my money for 6 months or even a year. I'm investing my money for the long term. And different investments are going to make me different returns in different phases of the economic cycle. So I've been investing in the ARK funds for a while. And yeah, 2021 and 2022 haven't been good. And they probably won't be good for a while. But I also invest in a lot of value companies. I also invest in emerging market ETFs, which are companies outside of the United States. I also invest in real estate. I also invest in startups. And so I have this diversification in my investment portfolio where if one thing goes down, I have something else to balance it. This is why I don't invest all of my money in just one thing. I have my money invested across different asset classes, startups, real estate, cryptocurrency, stocks. I also have physical commodities like gold. Then within the stock market, I have some diversification there too, because contrary to what a lot of people say in the YouTube comments, I'm not a genie. I can't predict what's going to happen tomorrow, and I'm not Warren Buffett. And so I have diversification in the stock market. I have different companies and I also have different ETFs. My ETFs give me exposure to different sectors. I have ETFs that give me exposure to the S&P 500. That's the value side. I have ETFs that give me exposure to emerging markets, countries and companies outside of the United States. That's my protectionary side. And then I also have ETFs like the ARK ETF, and I have some others as well that give me exposure to innovation. That's my growth side. So I have investments in different sides of the market because I don't know what's going to happen. I love entrepreneurship. I love investing in innovation, so I want to see that succeed, but I also understand that there's also risks, which is why I invest my money in different things. The next question is, what happens if we see a recession and a market crash? Aren't you worried about that? And no, not really, because successful investors are not scared of market crashes. We actually look for market crashes because these are great opportunities for me to come in and buy even more aggressively. If the stock market crashes, guess what? I have a list of companies and ETFs that I want to own, and when these companies go on sale, I just come in and buy even more. So on a potential market crash side, I understand that yeah, we have risks of a real recession coming, and if that happens and we see a market crash, well, I will just come in and buy more aggressively. But also on the inflation side, I also understand that inflation is a real concern, which is why I also diversify my money out of cash. Obviously, I own stocks, but I also own physical real estate. I also own physical gold. These are my protections against inflation, and I also have protections against a recession. So you have to be smart when it comes to investing your money because the recession and inflation issues are out of our control. We don't know what the Fed is going to do. The Fed says that they want to fight inflation. But if 3 months from now, the Fed turns around and says the economy is too bad, we can't keep fighting this inflation, and then they start stimulating, that's going to make inflation a whole lot worse, and it will boost certain companies in the stock market. You can't predict what's going to happen. Instead, you want to be a fundamental investor where you find good companies that are producing good products that you want to hold on for the long term, and then invest your money for the long term and forget about it. If you enjoyed this video, here's a video on the New World Order that I think you'll love. Thank you for watching, and as always, keep hustling. The first thing that Ray Dalio says that you need to do is stop hoarding cash. This is me paraphrasing what he said. What he actually said was worry as much about the value of your money as you worry about the value of your investments.